Hi, my name's Lynn Condell and I work in JMU in the student advice team, and my job is related to student funding. I'm the student funds manager, so we give advice and guidance about a range of student funding. When we talk about student loans, I think a lot of people don't realise there are two types of loans. So there's a loan for your tuition fees and there's also a loan for your living costs. So there's two loans. The tuition fee loan, if you decide to take that out, that gets paid straight to the university. And the maintenance loan, if you want one of those, that would be paid straight to the student. So it's for you to live off whatever you want to do with it, basically. You do need to apply for your loans each year of your course. So I think a lot of students don't realise that. You do need to reapply, and you can have a loan for each year that you're a student. Part-time students can have a tuition fee loan if they want one, and full-time students can have both the tuition fee loan and the maintenance loan. There are eligibility requirements attached to both loans, and that's primarily related to your residency. So they call them a home student, which is a very strange term, but basically that means that you've lived in the UK and there's no restrictions on your stay here. So we've said that you need to reapply for your loan each year, but there are also deadlines to apply. If you're starting university in September 2013, ideally you should apply around about January, between January and March ideally, and then you can be sure of getting your money for September. Now a lot of students are a bit hesitant about doing that because they think, oh, I don't know if I'm going, I'm not sure what course I want to do, I haven't made my mind up. Don't worry about that. You can go back in and change your application. You can change what university you're going to. If you want to, you can change the course, and you can even cancel your application if you decide ultimately not to go. But it's really important that you apply on time, so you've got your money for September really. I think one of the urban myths is that everybody's got to have all these loans every year, and no, you don't have to have a student loan if you don't want one. If you've got money, or for example if you stay in a home, in your parental home or your family home, you don't want to take out a loan, then that's entirely up to you. However, what I would say is that this is a very affordable way of borrowing money. So we wouldn't like students to go and get a bank loan, for example, or remortgage their houses, because the main benefit to this loan is the way you pay the money back. You only pay the money back if you are working and earning over the threshold. The majority of students and their families are all very interested in how they're going to pay the money back, because obviously that's a very important factor. What happens with the loans is that any loans you take out while you're studying for your tuition fees or your living costs, they all go into one loan account, a bit like a bank statement if you like. Each year you'd get a statement that would say, this is how much I've had for my living costs, this is how much I've had for my tuition fees, and then you get a statement that says, this is how much I owe, this is how much interest I've got. Then the April after you graduate or leave, if you happen to leave before the end of the course, your national insurance number gets flagged by Her Majesty's Revenues and Customs, HMRC. And then if your income is over the threshold, which is £21,000 at the moment, your employer would just start taking the money out your salary, just like your tax and your national insurance. So, and it's 9% of everything over £21,000. So, for example, if you earn 21,000, then you don't pay anything back. If, for example, you earn 22,000, then you just pay 9% of the 1,000. So that's £90, I think if my maths is right. So that's £7.50 a month. Lots of people ask about the interest rate on loans, on student loans. While you're studying, you charged the retail price index plus 3%. Then come your repayment due date, they would calculate your interest based on how much you are earning. Now, it's a sliding scale, so if you're earning £21,000, which you wouldn't pay any money back on, they would charge you interest just on the retail price index. So basically you'd be paying back what you've borrowed plus inflationary value of the loan. And then it's a sliding scale then up to a household income, your income, it's not your household income, of £41,000, which would be the retail price index plus 3%. But in between those two income thresholds, so 21 and 42, it's very small incremental increases. So, for example, if you're earning 30,000, it could be RPI plus 1.5%, for example. Lots of people ask me about, will taking out a student loan affect my credit rating? So will it stop me getting a mortgage? Maybe I won't be able to get a car loan in the future. And the answer is primarily no, but maybe, I suppose. What lenders will do is they look at your income, so what your salary is, and then they look at your financial commitments. So they wouldn't look at your overall loan. So if you've had 3 tuition fee loans, that would be £27,000. They won't say, oh, you've got a debt of £27,000. What they would look at is, oh, you're paying £20 a month back. So it's your financial commitments. So that's about responsible lending, isn't it? It's not about how much you owe in total. It's how much you have to pay out each month off that loan. If people want more advice, because obviously this is a lot of information to take in, then you could have the first point of call maybe should be the direct.gov website, direct.gov fees and funding, or we're more than happy to talk to people before they come to university, while they're here, sometimes even after graduation. Our contact details will appear on the screen apparently by magic.